Today's lesson is Chapter 13, Problem 2B. As you can see on your screen, let me share your screen. I didn't get it on properly. Okay, you should be able to see your screen now, and we're looking again at Chapter 13, Problem 2B. And this has to do with stock transactions. And so we're going to be looking at this problem from the point of view of Pulsar Optics. That's going to be the name of our company. And we are producing medical lasers for use in hospitals. The accounts and their balances appear in the ledger of Pulsar Optics on April 30th of the current year as follows. What they have is some preferred stock. Preferred stock, if you'll remember, is stock that we've sold to stockholders who have rights to dividends before common stockholders. That's why we call them preferred stockholders. This preferred stock has a dividend rate of 1%. It has a par value of $120. And again, a par value is just the amount that's written on the stock. It really does not have anything to do with market value of the stock. It's just amount that's printed on the stock. There were 300,000 shares authorized. What that means is that's how much that they have available to be able to sell. But there were 36,000 shares that were issued. And so what that means is they've sold 36,000 shares of the stock that they had authorized, and it's out there and available for dividends. The total value of the preferred stock is $4,320,000. This preferred stock also has with it a ledger account called paid in capital in excess of par for the preferred stock. And what that means is that when you sold the stock, you sold it above the par value. The excess of the amount that you sold it above the par value is the paid in capital in excess of par, and it's $180,000 for this particular company. So if you were to combine the preferred stock and the paid in capital in excess of par on the preferred stock together, that would give you the amount that you actually sold the stock for. And that would be for the 36,000 shares that were issued. This company also has what we call common stock. And common stock has voting rights. And so common stock is associated more with the ownership of the corporation. The common stockholders are paid dividends after the preferred stockholders are paid. But the common stock also has a par value that's written on it, and that par value is $15 per share. We had 2 million shares that were authorized. That means that that's how much that they had available to sell. That amount is not out on the market yet, but they have actually sold or issued 1,400,000 shares. So they do have 1,400,000 shares of common stock that they've sold. This 21 million represents the par value of the common stock. So if we took the 1,400,000 and multiplied it by the $15 par value per each share of stock, it will give us the $21 million in total par value. The common stock also has with it an account that's associated with it called the paid-in capital in excess of par on the common stock. That is, the common stock, when it was originally sold for more than the par value. The difference was $3,500,000. We also have an account called retained earnings for corporations. So instead of having a owner's capital account in a corporation, we use retained earnings like the statement of owner's equity in a proprietorship. So these are different accounts that are associated with the stockholder's equity that will be on the balance sheet. So in a corporation, the owner's equity becomes stockholder's equity, and these are the accounts that are associated with it. I might also like to add that all of your paid-in capital accounts are what we call adjunct accounts. That means they add to the stock accounts that they are representing. So in the case of paid-in capital in excess of par on preferred stock, this would be added to the preferred stock par value to get the total amount of the price that the stock was selling for at the time that they issued these 36,000 shares. And common stock works basically the same way. Paid-in capital in excess of par on common stock is an adjunct account. It's going to add to the par value of the common stock. So 21 million plus 3,500,000, the total of that is going to be what we actually sold the common stock for. Also, I might say that the preferred stock is a stockholder's equity account, so it's going to have a normal credit balance. And that's true of the paid-in capital in excess of par. It's an adjunct account, it's kept separate, but it too has a credit balance. So common stock would have a normal credit balance, or it increases on the credit side. And the paid-in capital in excess of par also has a credit balance, and it will increase on the credit side. Retained earnings is an actual account that will increase also on the credit side. In this particular company, they've given you the ledger account balances of the stockholders' equity accounts. And then they tell you at the annual stockholders meeting on August the 5th, the board of directors presented a plan for modernizing and expanding plant operations at a cost of approximately $9 million. The plan provided A, that the corporation borrow $1,500,000. And part of the plan was also that in B, that 20,000 shares of unissued preferred stock were going to be issued through an underwriter. So we're going to issue some of our preferred stock to an underwriter. And part C says that a building is valued at $4,150,000, and the land on which it is located is valued at $800,000. All of these things are going to happen, and they're going to be acquired in accordance with the preliminary negotiations by the issuance of 300,000 shares of common stock that is valued at $16.50 per share. This is the market value of that stock at that particular time. It says that the plan was approved by the stockholders and was accomplished by the following transactions. So what they want you to do is to journalize the transactions for plan A, B, and C. So you'll remember in plan A, the corporation was going to borrow $1,500,000. So this actually happened on October the 9th. That's when it happened. And we're borrowing money, so we're going to be receiving cash of $1,500,000. When our cash is received, cash is increased. And to increase our cash account, we would debit that for $1,500,000. The credit is going to be to the mortgage note payable, which is a liability account. Both our cash and our liabilities are increasing. And to increase a liability, you would credit by $1,500,000. So this is the first journal entry that they wanted you to record on October the 9th, and was really part A, where they said that the corporation, as a part of their plan to modernize their plant operations, they were going to have to borrow some money. In part B, it tells you that 20,000 shares of unissued preferred stock is going to be issued through an underwriter. So what that means is we're going to be transferring that stock over to an underwriter. And in return for that, we're going to receive some cash. And the amount of the cash that we're going to receive is $126 per share. So on October the 17th, we're going to create a journal entry where we debit cash for the amount of the cash received. And so if you will take 20,000 shares, which is the shares that we're going to issue, these are the shares that we're selling to the underwriter at $126 per share. So we're going to take $20,000 and we're going to multiply it by $126 per share. And that's going to give us a total of $2,520,000. As you can see, we're debiting this cash because cash is increasing by the amount of $2,520,000. To go along with this, we're going to issue our preferred stock. Since preferred stock is a stockholder's equity account, it's going to have a normal credit balance. In other words, we're going to increase our preferred stock on the credit side. And what we're saying is we sold that preferred stock, so our equity in the corporation is increasing. So I'm going to credit my preferred stock for the amount of the par value of the stock. When you issue stock, preferred stock is always recorded at the total par value. The way that we determine par value is we take the number of shares of preferred stock that have been issued, and we're going to multiply that by the par value of the stock. So the par value of this preferred stock was $120. That was given in the information at the beginning of your problem. $120 is the par value of the preferred stock. So we're going to take that $120, which is the par value per share of preferred stock, and we're going to multiply that by 20,000 shares. That was the shares that we had issued. So that the total par value is $2,040,400,000. $2,400,000. The remaining credit is going to be to our paid-in capital account because we sold the stock for $126 per share. That was above the par value. The par value is $120 per share. So that $6 difference is an addition to our paid-in capital. And so one way that you can do this is you could go ahead and credit the paid-in capital in excess of par value. Make sure you click on preferred stock because we're issuing preferred stock here. And that's the paid-in capital account. Remember that paid-in capital in excess of par value on preferred stock is what we call an adjunct account, which means it's going to be adding to the preferred stock on the balance sheet. The amount of the paid-in capital is the difference between what you received in cash and your total par value. The difference between these is $120,000. You could have also gotten this amount by taking the difference between the market value of the preferred stock, or the stock that the selling price of the preferred stock, which is $126, and the par value that was given to you at $120. That means the difference of $6 would be multiplied by the number of shares that were issued in this transaction, which is 20,000, and that will also give you 120,000. But probably the easiest way to solve this is just to find the difference between the debits and credits. So if we subtract the total par from the total market price that we received for selling those shares of stock, the difference between these two is a credit of 120,000. So that's what happened when we have issued 20,000 shares of preferred stock, which was part of Plan B to raise money to expand the plant operations. We were going to have to sell 20,000 shares of our stock. Also, what we wanted to do is we wanted to record on our books that we have a building that was valued at $4,150,000, and the land on which it was located, which was valued at $800,000, was going to be bought and acquired in accordance with negotiations by the issuance of stock. So this is a case where we've gone out and we bought a building and some land. We didn't give them any cash, but we gave them our stock. And the stock that we gave them was 300,000 shares. So what we're going to have to do is show on our books that our building has increased, and it would have increased by the fair market value of that building, which was given at $4,150,000. This was the negotiated price of the building, or this was the cost of that building. So I'm going to debit that to the building account. My building is an asset, and to increase an asset, we put it on the debit side of the journal entry. We also had land that was given to this corporation in exchange for some stock. So our company's land is going to be recorded at the fair market value of the land, and the fair market value of that land was $800,000. That was given in your instructions. So land, which is an asset, is going to be debited for $800,000. Because the land is increasing, we would debit it for $800,000. Now, instead of paying cash or borrowing money to buy this building and land, what we did was we gave whoever we bought the building from stock. And the stock was 300,000 shares, and it was common stock that we gave. And so what we're going to have to do is we're going to have to credit the common stock account for 300,000 times the par value. We always record our stock accounts at the par value. So the common stock is going to be increasing on the credit side because you're adding to the stockholders' equity account, and it's going to be for the amount of the par value, the total par value of that company. Since they issued 300,000 shares, 300,000 shares of common stock would have to be multiplied by the par value, the amount that was stated on the common stock, which was $15, is our par value. So 300,000 shares times $15, the par value of the common stock, would mean that the total par of the common stock would be credited for $4,500,000. So $4,500,000 is the credit to the common stock. The remaining account is going to be called the paid-in capital in excess of par value on the common stock. Make sure you choose common stock because we are issuing common stock here. And the paid-in capital account will be the difference between the debits and the credits. That's one way we can determine the amount of the paid-in capital. So I'm going to start with $4,150,000. That was the building's fair market value. I'm going to add to that the land's fair market value of $800,000. And then I'm going to subtract out my credit of $4,500,000. And that will leave me with $3 million, and that's not correct. Let me try this again. Add up your debits, $4,150,000. We're going to add to it $800,000. And then we're going to subtract from that $4,500,000. And that's going to leave you with $450,000. That's the balancing part of the transaction. Remember, your total debits always have to equal your total credits. We could have also determined this in a different way. We could have said the total of our building and our land together is the market price of the stock, and the difference between it and the par value will give you your paid-in capital in excess of par value. It all works out to be the same. So what we ended up doing was balancing this transaction with the plug figure. So you added up both debits and subtracted the credit you knew about, and the difference, the remaining part, would have been $450,000. So this is what we do in order to create this plan that our board of directors gave to us, because we want to expand our plant. We want to modernize it, and we thought it was going to cost us $9 million to do that. So this is the way that we were coming up with the way to modernize the operations for the company. And so these are the journal entries that you would have recorded. And so that's all that we need to talk about for this particular problem. So we'll stop the recording here. And we'll see you the next time.